This is your 13th program on accounting. It is about fixed assets. Current assets are expected to be sold rather soon. They are short-term assets. Long-term assets, also called fixed, plant, or capital assets, are to remain in service for several years. Although sometimes assets are hard to classify, most current assets like cash, accounts receivable, and merchandise inventory are clearly short-term, while land, building, furniture, and most equipment are to be used for longer periods. What kind of asset is a storage warehouse? Right. Land, buildings, furniture, and fixtures, and machinery and equipment make up most fixed or capital assets. Land and buildings are called real property. This word comes from royal, since the king once owned the land rights. Furniture or equipment is called personal property, or personalty, to distinguish it from real property, even though it may belong to a company and not an individual person. A company is often considered a person for legal purposes. Another way of classifying assets besides current and fixed, real and personal, is tangible and intangible. Tangible usually means touchable, so inventory, land, building, and equipment are tangible. Intangible assets might include accounts receivable, but the term is generally applied to property like patents, copyrights, leases, franchise, and goodwill. Does intangible always mean worthless? Right. But intangibles like patents and franchises, although valuable, usually are less readily marketable than most current assets. How would you classify a typewriter? Yes. Of course, anything, even real property or equipment, is a current asset to someone who is a dealer in it and expects to sell it soon. But fixed assets, which are held to help serve the main business of a firm, are recorded in a special way, so their gradual depreciation or reduction in value is charged as an expense. What is another name for such long-term property used in the business? Oil, gas, ore, and timber are called natural resources and are often classified as wasting assets, subject to depletion as the oil or gas is removed. Other assets are deferred expenses or costs, which are reduced or amortized over a number of years. Stocks, bonds, and term notes may be either short or long-term assets, depending on the available market for them and the intentions of the firm. They will probably be separately classified as investments. When a fixed asset is bought, it should be recorded at the total price, including all costs such as fees, commissions, freight, installation, and so on, but less any discounts. Interest on funds used during building construction is sometimes included, but interest on long-term loans to pay for ownership is a financial cost which must be expensed. The book value of buildings is gradually reduced by depreciation, but would you think the value of the land is depreciated? If you bought some land with an old building on it for $20,000 and paid $2,000 more to wreck and remove the building, then $1,000 for a survey, real estate agent help, and land leveling, how much asset value would be debited to the real estate account? Right. A long-term asset depreciates because it either wears out, becomes obsolete or inadequate, or begins to require excessive maintenance. A soundly built general-purpose building retains its value for a long time, but even a good computer or calculator soon is worth less, as newer and better models become available. If a building costs $25,000 and is expected to last 25 years, you might charge depreciation expense $1,000 per year. This is called straight-line depreciation. But other factors and procedures can be considered. If a small computer cost $6,000 and had a useful life of 5 years, but could then be sold as salvage for $1,000, instead of depreciating it at $1,000 per year, you could depreciate it more the first year and less the 5th year. How would you describe these last factors? Yes. In addition to depreciating a fixed asset a constant amount, there are two widely used procedures for increased depreciation in early years and reduced amounts later. This idea is called accelerated depreciation, and the two methods are referred to as declining balance and sum of the digits methods. What is another name for constant depreciation? The declining balance method charges a larger percentage, often 20% to 40% of the remaining value, each year to depreciation expense. But since the remaining value is reduced each year, depreciation, which begins at a greater amount, eventually becomes smaller. A $6,000 computer might be depreciated 30% of the depreciated balance each year, which could provide $1,800 depreciation the first year, but only $432 by the 5th year. The sum of the digits, or sum of the years digit system, employs an arithmetic trick to vary the rate. If the period selected is, say, 5 years, the numbers 1 through 5 are added, giving 15. Then the proportion to be depreciated is obtained by reversing the digits, giving 5/15 depreciation the first year, 4/15 the second, and so on to 1/15 during the 5th year. With the straight line and the sum of the digits methods, a salvage value of 10 to 20% of the original is often selected, and the balance, the depreciable value, is depreciated. But since the declining balance method never goes to zero, a separate salvage value is often not specified. Here are the depreciated balances of a $6,000 asset depreciated over 5 years with $1,000 salvage value using straight line and sum of the digits methods, as well as a 30% per year overall declining balance method. Which method provides the greatest first-year depreciation? Yes. The rates were selected to give about the same value at the end of 5 years. Which method has the lowest depreciation in the 5th year? Yes. There are ways to calculate the percentage of depreciation on the declining balance which will result in a selected salvage balance in a certain number of years. But most often, the double declining balance means that you use twice the straight line rate. If the life is 5 years, instead of a straight line 20%, use 40% of the declining balance. If the life is 10 years, instead of 10% of the original sum, use 20% of the declining balance. What are some of the features of the variable rate methods? Yes. For rapid early depreciation methods probably more closely reflect the real market value of the asset. There are other methods for calculating depreciation, including the calculation of unit output. If a machine is rated to perform 1,000,000 operations expected to occur in 10 years, perhaps it should be half depreciated at 500,000 operations, even if this occurs in only 3 years. Natural resources may be written down or written off in the same way. When geologist reports indicate that 25% or half or some other portion of the available oil, gas, or minerals have been depleted. Which would be most important in calculating the reduction of natural resource assets? Yes. On the other hand, it is normally impossible to assign a unit cost to the reduction of intangible assets such as patents and copyrights unless the lifetime unit sales can be predicted. Patents are granted for 17 years, and if patent rights are purchased 10 years before expiration, it is customary to amortize the cost at a constant rate, in this case at 10% per year. Royalties for mineral rights or copyrights may have estimated total unit lives, or may be written down at a constant or variable rate per year. What is the term for reduction of intangible assets? Yes. A copyright which protects artistic and literary work for 28 years may be renewed for 28 more years.